So, you've just had a look at your credit report and it says that your credit score is fair. What does this mean? What if it were good? What if it were bad? Why do you want your credit score to be, say, excellent? In this video, I show you the critical differences between all of the levels of your credit scoring. More importantly, I show you why you want to have an excellent credit score. Be sure to watch till the end so that you can be empowered to use your credit score to build wealth. Hello and welcome to my channel. My name is Nyiko, financial advisor and financial coach. Most importantly, I am all things personal finance and entrepreneurship. So if this is the type of content that you would like to see more regularly, please don't forget to smash that like button, subscribe, and hit that notification bell so that you can be notified every time a new video comes out. Right, let's get into it then. This is what your credit score can get you today. Will you build wealth in this way? So you've just gotten back your credit report and you have found out what your credit score is. All you know is what your credit rating is, but what does this mean and why should it be important to you? How will having a good credit score make your life significantly better than would have been the case if you had, say, an average credit score? Without your salary increasing, would having a, say, excellent credit score help you? First, let's cover some basics for those of you who may not know. If you already know this stuff, please bear with me. I will be quick. So, what is a central bank? According to Oxford, a central bank is a national bank that provides financial and banking services to its government and to the commercial banking system. It also implements the government's monetary policy as well as issuing currency. That's the fancy version. In layman's terms, a central bank is your bank's bank, and when things get bad, it is your government's bank. When you hear that your government or your country has trillions of dollars worth of debt, this is who they owe. I will leave it there. If you're from America, your central bank is called the Federal Reserve. If you're from Australia, your central bank is called the Reserve Bank of Australia. If you're from New Zealand, your central bank is called the Central Bank of New Zealand. If you're in Europe, your central bank is called the European Central Bank. If you're in the United Kingdom, your central bank is called Bank of England. If you're in Japan, your central bank is called Bank of Japan. If you're in South Africa, your central bank is called the South African Reserve Bank. This being said, what is the repo rate? If you had breakfast this morning, please smash that like button. I really need to know. In repo, one party, in this case, the central bank, sells an asset. This asset will usually be a fixed income security. This asset will be sold to another party, in this case, your bank. This asset today will be sold at one price with the commitment to repurchase it again at a different price at a later stage. This again is the more complicated technical term. In layman's terms, the repo rate is the interest rate that your central bank charges your bank to borrow money. Okay then, what then is the prime rate? If you had dinner last night, please smash that like button. I really need to know. The prime is the annual percentage rate, APR, that your bank will charge you based on the money that they borrow you, that they have borrowed from your central bank. In other words, it costs your bank money to borrow from the central bank. This cost they then pass on to you through what is known as the prime rate. The prime rate is thus the repo rate plus the bank interest rate. What I'm trying to get you to understand is that you will always be making the central bank as well as your bank money. So next time you hear that the repo rate has gone up or down, know that this will have implications for you because the bank will always pass these costs on to you. This being said, as the economy ebbs and flows, so will the repo rate, and thus so will your interest rate for any debt that you already may have, unless you have a fixed interest loan. So the numbers that we're going to be looking at today assume a fixed rate. Much more than this, they are based on prime as it stands today. So again, if you were to be able to successfully secure a loan, your interest rate could go up and down based on the repo rate going up and down, based on the economy going up and down. Bear this in mind. This will happen throughout your loan term, so you need to make sure that you will be able to afford your monthly repayment amount, even if there should be a sharp increase in the repo rate. Okay, that's enough from the financial coach. Let's talk about credit scores. Please note, the ranges and allocations may differ based on where you are and the credit reporting agency. I have used the FICO ranges. For the purpose of this video, any difference in ranges from credit bureau to credit bureau are immaterial. The overarching principle is the core. Focus on the rating category and its implications, not the number, lest you lose the whole point of this video. So, whichever country you may come from, whichever rating agency you may be using, this video is useful to you. Credit score ranges and their average interest rates. Please note that this is assuming a prime interest rate of 3.25%, the USA prime rate at the time of recording this video. Excellent credit score, 800 to 850. Well above average, you are an extraordinary borrower. You will get the best interest rates and payment terms for your loans. Next up, we have the very good range. This is from 740 to 799. You are above average. You are a dependable borrower. Competitive terms from lenders and mortgage originators. Then we have the good credit score range. This is from 670 to 739. Near or slightly above average, still considered a good score. This is the minimum credit score range to get fair terms. Next up, we have the fair credit score range. This is from 580 to 669. This is where you're below average, but lenders will still approve a loan. You can still get loans, but only under your lender's conditions and at an increased interest rate. Then we have the poor credit score range, and this is from 500 to 579. This is significantly below average. Lenders view you as a risky borrower. Your interest rate, if you are successful, will at best be 3% above the average. Then we have the miserable credit score range. This is for anything below 500. At this level, getting any type of conventional financing or fairly priced financing is close on impossible. Please let me know in the comments if any of this is making any sense so far. So how does this affect your borrowing practically? So let's make an example of a house you want to buy. We will keep it simple and not focus on too many data points so that we can focus on the main point. Our considerations will only include interest and exclude the following: rates and taxes, PMI, or if you like, private mortgage insurance, property and household insurance, and any other type of fees. So you're buying a house. The purchase price is $300,000 and the payment term is 30 years. Please note that these rates are derived from US market-related rates. If the rates in your country vary, please do not be alarmed. The principle still remains the same. For a very good to excellent credit score, your interest rate will be 2.516%. Your total monthly payment will be $1,188. For a good to very good credit rating, your interest rate will be 2.738%. Your total monthly repayment will be $1,223, an increase of $35 a month compared to the excellent rate. For a credit rating of good, your interest rate will be 2.915%. This will mean that your total monthly repayment will be $1,251. This would mean an increase of $63 per month compared to excellent. If your credit range were to be fair to good, your total interest rate would be 3.129%. Your total monthly repayment would as such be $1,286. This would be an increase of $98 per month compared to excellent. If your credit range were on the higher side of fair, your interest rate would be 3.559%. Your total monthly repayment will be $1,357. This would be an increase of $169 per month compared to excellent. If your credit score were to place you on the lower side of fair, your interest rate would be 4.105%. This would bring you to a total monthly repayment of $1,450. This would be an increase of $98 per month compared to excellent. Other ways your credit score can affect your borrowing. If you haven't already, please smash that like button, subscribe, and hit that notification bell so that you can be notified every time a new video comes out. Lenders have the right to adjust the way that they sell debt to you based on whatever they feel may mitigate or justify the risk. In the example that we just looked at, the approach was pretty basic. The greater the risk, the greater the reward. The higher your credit score, the lower your interest rate. They could also choose to adjust the arrangement in other ways though. They can choose to give you a smaller credit facility than would have been the case if your credit score were higher. They could also decide that they would be a lot more comfortable if you were to have skin in the game, thus forcing you to raise a down payment for them to approve your loan. They can also choose to use a combination of these methods. Or, if things are really bad, or if they are really conservative, they can decline to do business with you altogether. This would make subprime lenders your only option. This, of course, is assuming that they would agree. Who are subprime financiers? These are the guys who go where conventional lenders will not go. Obviously, they have to make it worth their while. And who foots that bill? Of course, you. So what does all of this mean for you? The sad reality of all of this is that life tends to be more expensive the poorer or closer to poor you are. You generally have less disposable income to be able to use to escape your situation. Insurance and loans or credit also tends to be more expensive for you than would have been the case with, say, your more affluent counterparts. If you haven't already, please check out my video, How to Fix Your Credit Now, Fast. If you are in a situation where your credit is not the best, mathematics is not going to get you out of that situation. Financial literacy will. You need to work as hard as you can, not just to get a bigger paycheck, pay less on interest, pay less on insurance, save as much money as you can, but improve your financial literacy so that you can become more efficient with your finances. So the point of this video was to show you what it looks like when your credit score is not good. More importantly, for you to be able to identify when a lender or a bank perceives you to be a high risk. In this particular case, we looked at a mortgage, but different types of debt are priced differently. In other words, you will generally pay lower interest rates for secured financing versus unsecured financing. For example, your house is an immovable asset. The banks have literally centuries of data on properties, how they appreciate, and how the underlying asset behaves. It has a fixed address, so they know where to find it if you were to start defaulting on your loan. Needless to say, this is the cheapest type of asset-based finance. Your car, for example, is also asset-based financed, but the dynamics are different. Your car can depreciate, it can break down, it can be involved in a collision. They might not be able to find your car if you default because you might go park at your granny's place. While there is an asset to back up this type of financing, it is not nearly as secure as would have been the case with, say, a mortgage. Needless to say, the most expensive debt is unsecured debt because there is no asset to back up this type of loan. This being said, generally speaking, it would obviously be the most expensive type of debt. Try to learn how the different type of debts are priced. If the lender wants you to pay a down payment where a down payment is not usually the case, you might be seen to be a higher risk. Find out why. If you are a regular on this channel, you will know that I am not a fan of using debt to finance the procurement of liabilities. To this end, if you haven't already, please check out my video, Your Mortgage is a Poverty Trap. I do, however, appreciate that most of you are going to go out and get this type of debt anyway because this is what modern day society has normalized. If you do insist on it, I strongly urge you to wait until your credit score improves before you take on this debt. This will make the cost of taking on this debt significantly cheaper, freeing up more of your capital so that you can deploy it to actually build your wealth. The greatest thing about having good credit is that it opens up your options. You can speak to whomever you want about getting the type of debt that you're looking for. If you're a sought after client, all of the lenders will be clamoring to get your business. I speak about this in much greater detail in my next video entitled Why You Should Never Allow Your Credit Score to Be Anything Less Than Excellent. If you have made it to this far, thank you so much for watching this video. I really appreciate it. If you haven't already, please smash that like button, subscribe, and hit that notification bell so that you can be notified every time a new video comes out. See you in the next video. Cheers. So I've been running my financial planning practice for about 8 years now. So I've been thoroughly exposed to all the methods that work and all the methods that don't work. And as an extension of this YouTube channel, I've also now started to consult one-on-one, helping you with wealth coaching. We talk everything from credit, how to speak to your banks, buying cars, property investment, everything you need to know so that you can achieve financial freedom successfully. If you want to get in touch and schedule a consultation, contact me via the email provided in the description.